All right, welcome and good evening, everyone, to tonight's webinar. We're going to be talking about using indicators. Now, before we get to the actual webinar, let's take a look at the risk disclaimer. I'll give everybody a minute to read that. All right, so what are we going to discuss in this webinar? About me, obviously I'll introduce myself really short, see what's going on. The second one is we're going to talk about what indicators really are. And then we're going to look at the moving average today. We're going to look at the MACD, RSI, and the stochastic. We're going to look a little bit in depth on how to set them up one by one, and then talk about how you would individually use them. And then in the end, I added using the indicator. So what we'll try and do in the webinar is actually do a live trade during the webinar using these indicators only as like your signal markers. And at the end, during the webinar, we'll obviously have the Q&A as always. For those that are in YouTube, you will have up to the using the indicators part. Right, so about me. Well, first of all, who am I? My name is Mike Rottink. I am Dutch. I live in Athens, Greece. I studied international business studies in Deltion through the Cambridge system. This is the period where I slowly started getting into trading. At first, it was a different model. Then I transformed it into what was Forex. Now, like most of you, the start wasn't too great. I struggled a lot with trying to understand some of the basic concepts by following wrong advices. And there's so much information in the internet. Obviously, you listen to them, it's like, okay, well, that makes sense, and it turns out it doesn't. So that costed me about 3 accounts. Well, 2 accounts. The third account I got low, and then I climbed back, and that was the account that basically sustained me from then on. And over the years, obviously, added to it and did some different things. But yeah, fast forward about 10 years of trading, about 15 years actually now. And I started about 5 years ago doing webinars here and there, trying to convey, basically my experience, what I found worked for me, what doesn't work for me, and some pointers. Really, it's just from my perspective what I've been doing. And that brings me to what do I do, right? So, yeah, obviously I trade. Now that has over the years progressed into different types of investments, a little bit less retail and more like offshore investments and funds and stuff like that. I still do my day trades from time to time, just to keep myself busy, because I still obviously have a love for it, as a special place in my heart. On top of that, I do these webinars. Clearly, that's been 5 years now, like I mentioned. On top of that, I do the mentoring. And yeah, other than that, I'm also working on becoming a financial advisor. So I'm going through the CISI licensing and that whole fun story, which is an interesting route to take. It's a bit slow, but there we go. That's basically me in a nutshell. Right, so first of all, let's actually talk about these indicators. So what are indicators? Well, first of all, you don't need to see them as like the be all end all. It is literally a support tool. So the way that you need to see that is indicators help you with your decision making on your exit and entry. First and foremost on your entry, and then obviously on your exit at the end. It helps you micromanage along the way in case there's a spike or something like that. But it should never be the primary tool for you to initiate the trade. Now, obviously, today we're going to talk indicators. We're going to utilize it that way. But generally speaking, you have a few other factors that go in front of it, like your technical analysis, your fundamental analysis, your risk management, your trading strategy. And when you have all your decisions made, you take a look at your indicators. And if, based on all those factors, the indicators emphasize or basically confirm your thought and your analysis, then you have now that tool available to make that slightly better judgment point on where to go in at what point. Now, within indicators, there's basically 3 main categories. There's a fourth one. The main ones, you have trend-based, you have oscillators, and you have volume-based. Now, the trends are usually overlays, so they go on top of your chart. This is why it's important to pick one, maybe two, different one at best, because if you get too many, just like with technical analysis, where people overcomplicate things, what happens is that you can't actually read the chart anymore. The amount of times I've had students come to me with a chart and they have like, 100 different analyses running at the same time, and I can actually not read the chart anymore. Like at this point, what are you trying to find out, right? So indicators all have their own set as well, and it's important to find a set of indicators that, like the ones that I'm going to discuss today, they work together because they all do a similar thing, slightly different. So you have one thing that you're working on and not contradicting, let's say, information working against each other. Oscillators are the ones that go underneath your chart. They're their own bar. They get plugged under your screen, underneath your chart. You'll see that in a minute. These are things like the MACD, right? The stochastic, the RSI, stuff like that. They will be underneath it. Now, volume, MACD is part of volume because it utilizes volume and a moving average. We'll go a little bit further on that in a minute. Now, the fourth one that I mentioned on is Bill Williams. This is a separate category if you're using MT5. Basically, it's somebody that was basically changing with the way the indicators work to more specifically work for him. So it's basically a variation of existing ones, which are relevant for some strategies. Not mine, I've never used them, but for some strategies, they use Bill Williams instead of the standard one. So that's the fourth one. And I already touched on the last part, right? So that's pick your information, which is really important. As I mentioned, if you don't pick your information, you don't pick exactly what you're trying to find out with your indicators, being that support tool that they are, you're going to get a lot of contradiction in your own signals, meaning that you never actually get a clear yes, go, or no signal. You're always going to get like a contradicting signal, which means you're never going to get a clear answer. And on top of that, if you have too many of them, at that point, there's so much data to analyze and read at the same time, especially when you're a trader in low time frames. You can only analyze, absorb, and then call on that much data at a time, right? If you're trading on a week, you have all the time in the world. But if you're trading on 5 minutes, well, every candle's 5 minutes, so you have to make your decisions fairly fast. On an hour is a little bit like the in between, where just generally where most of us trade. But again, you pick a set that works together, that have similar ideas on what they're trying to figure out, that work together, not that contradict each other because they're calculating different things like breakout measurements and fractals together with moving averages, right? Because the one is trying to dictate a trend, the other one's trying to find the contradiction of the trend. So you're right, you have two crossing, you're trying to find two different things at the same time, which they'll never line up, because when the one says go, the other one says don't go, and the other way around, right? So this will become a bit more clear when we go in the chart, what I mean by that. So let's talk about moving averages, because this is basically the core for most basics. First of all, the type is obviously an overlay. It's a trend, right? With a moving average, you're literally trying to find the way that the average candles have been moving. So the average of the candles have been moving over a certain period of time. We're going to set up the moving averages in a minute. I will explain there what that indicator of time is exactly. But obviously these lines go on your chart. So when you talk about how many moving averages, should it be a single, a double, a triple, quadruple, pentuple? I mean, I've seen 5 moving averages. You obviously the mustard and stuff like that. Single generally doesn't tell you a whole lot. It just gives you a smooth line of where the average candles have been closing based on the time frame that you're using. A double gives you somewhat of a signal when you have a fast and a slow, for instance. And I'll come back to fast and slow. There's a difference between a simple moving average and an exponential moving average. Basically, if you talk about moving average types, the simple moving average is basically an arithmetic mean, meaning that it's slow, but it makes it more smooth, which also makes it less prone to false signals, right? When you talk about an exponential moving average, it's way more reactive. In other words, obviously because it's exponential, it tends to react faster to market changes. That also makes it more prone to false signals, right? So it's a give and a take, right? You can't have fast reaction and smooth at the same time. It's either it's fast and gives you false signals from time to time, or it's smooth, which doesn't always give you the signal in time. Sometimes it's a bit late, but you get less false signals, right? Now, generally speaking, in an exponential moving average, you basically take the weighted average, right? I'll get back to weighted average. So this ties into the single, double, triple. So what do you want to do is you want to have, I would say up to 3. We're going to do 3 today as well. Double, you already get a single, but triple, you basically have a slow, a medium, and a fast. If you go to 5, you get like basically these in-between brackets on top of that. Not slow, not fast, and basically not fast, but not medium either. You get something in between. Now, generally speaking, and that's what we're going to do, we're going to set it for 200, 150, being slow, medium, fast. And this is the most commonly used, but you can also use, let's say, like I said, a 5 one, you would have something like 200, 150, 20, 15, or 30 and 15, something like that. So you get 2 even faster ones in the bottom, which helps in slow time frames. It doesn't help you in slow time frames, like a day. It will slowly move up. The 2 fast ones will clip through the other lines pretty fast. The slow ones will actually take a while to actually start moving. So if you extrapolate this to, let's say you're trading on 5 minutes, the lines are going to constantly be crossing each other because you have 2 extremely fast moving lines that are going through the medium. So you're going to get a lot of signals that basically aren't signals. So that's why I say triple is generally the most, because you have a spread where you get a signal from time to time. So let me show that. So when we set it up, let's set this up. So here I have a chart. We're going to go to the day chart. Actually, let's do an hour. That's fine. In this case, this is the pound versus the dollar 1 hour. It doesn't really matter what you're seeing here. So let's just set up the indicator itself. So basically we go to insert, we go to indicators, and here we go to trend, and you will see the moving average right here. So let's grab that one. Now, the period, let's start with the slow one. So the slow one, we do 200. Now, simple moving average, like I said, is smooth, right? In this case, we want smooth. We're trading on an hour. We're looking at a day and 4 hours and stuff like that. So in this case, I want to use the simple one for the period of 200. Now, what the 200 means is it calculates back 200 candles, right? Is that simple? So in this case, the last 200 hours, it will take the high and the low and divide that by 2. That's what this means. So if you would do it on close, it will take the last 200 closing prices, last 200 open prices, last 200 highs or lows, which is these wicks, right? And then you get typical price, which is the high plus the low plus the closing price divided by 3. And then the last one is the weighted, which is high, low, divided by the double close, divided by 4. So the reason why that is it double weighs it. Basically, the actual closing price gets weighed twice. And that's why it's called weight. Now, in this case, we just want the median price because we're going for a simple, right? Don't worry about so much about smooth and linear. That's a little bit further down the line. Exponential, you would actually use a weighted close. You want to slow down the line a little bit. You can use the median price if you're in, for instance, 5 minutes. But then remember, exponential has a tendency to give false signals. And generally speaking, I trade, with weekday 1 hour. So simple is fine. Now let's give it a color. Let's want the week. We want the week to be like a maroon color. So there's our week. So if we go to a week here, you can see like, okay, well, that's really far away. And it's true, but you can also understand now how these signals basically start working out. On just this line, you will basically have an idea that when it touches this line, like, okay, we'll probably keep going because every time it does, it eventually does go through. Like here, it went up, then it got bounced down by the news. This is February 2020. Everybody know what that was, right? February, March. right? Corona. So that's where that spike downwards came from, and then the recovery. So it still did whatever it wanted to do here. It just got delayed by half a year. Well, by actually about 8 months. Like that's all this did. Delay what was supposed to happen here, which it did later, is what it did here. So this is one of those moments where you get a false signal. This is why fundamentals and stuff like that are important, but let's focus on the moving average. And we said we do a triple one, so let's set up a triple one. I'm not going to discuss every single one of them as I set them up, but let's go moving average number 2, and we set 100. Same settings, just different color. So let's say we do purple. So here we already get these weird crossing moments. Right, so here they barely touched, and then here they crossed. So you can already understand that one of your Q signals is a cross. Now you can also combine that here with a nice rising star, right? Price action. So you already had a signal on price action. You have a signal on your crossing after the market close. So here's basically your call, like, okay, this is going to shift direction from up to down, which is what it did, but it's not always going to do that. So let's add a third indicator and see what it looks like then. And that one's going to be 50. Same rulings. You can see that these stay the same. If you do one moving average one way, you do them all that way. Don't do different ways of it calculating something, because then you get cross signals with different variations, which doesn't make any sense. So that one's green. So here we can see how the crossings really work, right? This one barely touched. Here we're going up. So let's say we're in this market. Let's say we're over here, come from this massive downtrend, and it bounced off here. It started going sideways. It touched our fast moving average here, indicating like, hey, I want to keep going. Back then, it was basically at this support, right? From these, resistance at that point, where it kind of bounced off probably. And then eventually it did go through, and now it touched the second moving average, which is another signal. And now you get the crossing, which basically tells us, well, this is time to get out, because it also touched our slow moving average now. Right? If it would have gone through that, these two lines would have started curling up and it would go straight up, right? You flip them around. Then the slow is going to be at the bottom and these two will be on the top. But basically, here you have your first indication. It touches your fast line right here. It closes above your technical analysis that you definitely had back then, because you had these two bottoms. And then that would have been your entry point based solely on this. Right? Solely on it crossed my fast, so I'm going to take that buy. Now, you would have then probably closed it here, most of you, because you also started getting close to this next support/resistance. So this would have probably been your take profit, your 80% there, micromanagement, et cetera, et cetera. Now you then close it, you pulled back down and it bounced off again. And you now get your second entry basically here when it crosses again. And you have your exit when these two lines cross, knowing that, okay, we're probably going to flip now. Normally speaking, it would say it keeps going, but we saw here that it touched our slow and it didn't go through. We also had the upcoming there, which wasn't anywhere near yet. So it was probably a day resistance somewhere along there, or where we were playing here. There it is. So based on the day, let's see if we could find something. Where were we? Here. Yeah, you had this one right here on the day, right? So you have these wicks and this stuff. So yeah, that's basically where it bounced off. I was just looking on this side actually, but yeah, it's exactly where it bounced off. So right on your technicals, you would have had your answer. Now, let's go back to the week. Where were we? Here. So here we can see we have a rejection. It didn't go through your smooth. We had that daily. We now have a double top basically also created right here. That is after this red candle closed, guys, by the way. Not after the green, after the red one closes, because then all this you wouldn't have, but you would have confirm 1, confirm 2, right? So then you would have your selling opportunity. You go through your line, meaning we continue, go through your line, we continue. and then you have this pullback hitting your fast or your medium in this case, that would be your exit signal again, right? While you're going down, it can cross through them, but once it goes back up, like where it hit it somewhere over here, this would be your indication signal like, okay, guys, this is where I go out at the start of this candle, basically. So the second that this candle closes, let me zoom in a little bit. Work with me. There we go. So this one closed. And I know this is a week. So obviously this is like, half a year, but it's for the example how the candles work. We're going to look at a smaller time frame in a minute. And then it bounced off and it did go down a little bit more. And then it went back up and then it went back down. But if you would have waited for all this, like I said, this is a week, so it would have been quite a while. So here we have a bounce rejection. You wouldn't go in because you have the rejection. Maybe you took a sell. Okay, you had a 3-week sale. Back in, rejection. Okay, and here, all the way here, it basically said buy. This is that false signal because you would have been in the buy. It would have been basically not running around. Your stop loss would be somewhere over here. You would have knocked out just before because this is where COVID really started ramping up, right? Early 2020, and then March happened, where everything basically just collapsed with all the mandates and everything else. But as you can see, the market will do what it wants to do afterwards anyway. Same with 2008. It just took 3 years to recover, but it still did the exact thing we thought at the end of 2008 what it was going to do. Right? You basically just stalled the market for a few years. So here we go up, and now let's take a look at some smaller time frames and see how those signals will work there. So here with a triple moving average, let's take a look at where we can find our smooth right here, right? We came up from the bottom, and here you see the slow is finally crossing the medium after you went in from here. If you took this entire buy, great. But let's assume you did. Right here, you first time close above the fast, so this is your entry. Let me put it a bit more center right here. Hey, work with me. Can I zoom in without? There we go. So this is your first real confirm. Maybe you went in here already. That's okay. But let's say you were late for that and you went in here for the first time. You closed maybe one candle later because you like to wait to make sure. I know a lot of you do. That sounds familiar to some of you. I'm sure it does. And you hold. You go through the second, the medium. You hold, you hold, you hold. And here it crosses and it closes outside of your slow, but these two cross, meaning that is your closing signal. And if you would have closed on this one, maybe the next candle, because that one went red first, you would have basically, let's say you went in here, you would have gone out, let's say here. That's your trade, right? So you would have done this trade. It's a 26-hour trade. Easy peasy lemon squeezy, right? It did continue onwards a little bit more because it did break. However, it had a little bit of a pullback first. Okay, it got rejected. So this was a new signal where you could maybe say, okay, I'll take a new buy because you have this downward system where it then got rejected off the slow moving average where it bounced off. So here you have, okay, it closed on it. It's probably on the 4 hours right on it. No, the 4 hours was higher. Wait, where were we? Yeah, we were here. So the 4 hours, it already looks different. There it was on the slow. Go back to 1 hour. Boop. So here we keep going down. We get rejection stop. So here would be potentially a new buy. Let's say you go in later again. After it closes outside of the support. Well, what was the resistance back then? The support then turned into a small resistance here, but became support again. So let's say you go in on this candle. Somewhere in the middle, right? You keep going, and then you see here, you have that second cross again, where it tells you to go out, and that's exactly the highest point in this case, so you actually would have a perfect exit. And then you follow it again, it starts going down, you're still holding, you're still waiting, you know that there's this, let's take, that was the resistance line, right? So you're waiting for it to cross this line, and it did. Let's say you were waiting for it to go through here, and it just happened in 1 hour. So let's say you were holding all this way and then it spikes. You missed that trade. That's okay. Because here, you get that rejection, it closed just underneath it, and then it went back up and it closed. So let's say you went in late, you went in on this red candle now, knowing that it got rejected on this line, it closed. So you go in here and you follow it and you follow it and you follow it, and here you set the crossing. So you take the safe bet and you go back out. You didn't make a big trade, but you made a winning trade nonetheless. Now, obviously, some of you might say, yeah, but what about this part? Well, your stop loss should be underneath the previous low, so this should have not bothered you. If you go in late like this, now obviously you have a resistance here, and you had these two bottoms because this is where we went in, this red candle. So if you would even consider this, which isn't lining up that well there, but maybe further down, we're not going to look for that now, not technical analysis. Your stop loss would be this, and you would go like, well, I have these two wicks, so let me put it underneath that. So your trade would look something like that. And you would basically go in from here and you would go out on this line. So let's say you go out here, you still made 15 pips without much risk, right? It's not a great ratio. Obviously, it's a 1-to-1 ratio almost. So risk management wise, but forget about that for a second. So let's keep looking. So here we have that crossing. It goes down. It got bounced off. We have the support. We have the fast now crossing through. Okay, we bounce off of that. So let's say you go in late again. Let's say you go in here. You go all the way back first. Again, the ruling would still be somewhere over here. You might get feet, but you keep holding, and then you get your exit here. So your entry would be, let's say, on this candle somewhere, and your exit would be on that candle somewhere. This would have been the optimal high. You didn't get the signal there because it can only catch up so fast. That's the downside of smooth. With exponential, this would have bounced up a lot faster, but you also get a lot of false signals. Like here, it will tell you buy, it will tell you buy here. And then, here it would have told you buy probably as well, where it then heavily went to do a sell, things like that. Okay, so that in an essence is basically a moving average. So here, if we look at the current market, right, we went through the fast, back through the slow, and we now are on the slow, right? This is the fast, medium, slow. If you're not sure which one is which, if you hover on the line, it will tell you what your rating is on it. So here it says 50, this one says 100, and here it says moving average 200. And out of that, we can basically conclude, okay, so this is my slow. They just crossed and everything. We're just starting to go down. So this is still catching up. And this is why, as a tool, it's not your only decision-making tool. So that is, in essence, the triple moving average. Now, the rest is going to be a little bit easier because you have much clearer signals. So let's look at the MACD. So the MACD is basically, I wrote it out for you. It's a moving average convergence divergence. So basically it takes a look at a moving average based system, but it looks at the convergence and divergence of the market based on volume. So it's an oscillator, meaning it goes underneath your chart. You'll see that in a minute. And the purpose of it is basically to give you a moving average signal for when it moves outside of range of the volume and back in. So you already understand that the signal triggers are when it moves out and when the signal line moves back in. It's that simple. Right? So you could actually say, like, I open at one, close at the other, and open the next trade on the other one as well, because that's when the market flips, according to the indicator. Right? And that's its purpose. That's the only purpose it has. So when we take a look at the MACD, so let's take a look at the MACD. I'll recap in the Q&A. Just hold tight. You can just ask me again. So let's take the moving averages out. No, not that. Control I. If you want to know how to do that, Control I is your shortcut. Control B is for all your other stuff. You just Control Delete. Boom. Fresh chart. Now, let's put in the indicator for the MACD. It's an oscillator, like I said, and it's abbreviated as MACD. Put that in. Now, the MACD generally has a 12-period EMA. You guys remember EMA? That's an exponential moving average. So you can understand why I use my triple moving average as simple, because this uses two exponential moving averages, a fast and a slow. Now the general periods are 12 and 26. And remember, the period means the amount of candles it counts back. The longer the period that you go back, the slower the line moves, right? Because it takes more into equation. Okay. Now the MACD SMA is your signal line, which is a simple moving average. Now the rating between the first one, the fast, and the simple moving average is always half of each other. So if I make this 24, this should be 12. And this one should be double the first one plus 2. Don't ask me why, that's just the way it works. 48 would be double, so this one would be 50. But generally speaking, 1224 is perfectly fine. Not 12,024, hello? 26, sorry. So 24 is double plus 2 is 26, and this is half, so that's 6. Now in this case, we're already calculating with the slow moving averages, the high versus the low, so the high and the low, so both sides of the wicks, and take the medium of that, not the closing price, not the body of the candle, the wicks. So here we want to do what? Do we want to do the close only? Would we like to do the same thing? The high, low, and the close? Or maybe just the closing price? What do you think is more important for volume? What do you guys think? For volume, which one do you think you should take? Different strategies have different workings of this, but all right, we got 1. That's correct. Wow, you guys are brilliant. Yes, everybody says close. Yeah, you're right. The closing price is more important, right? Because for volume, we want to know the actual closing volume of that candle. We don't want to know how much moved around in it during the day. We want to know what happened during that candle, right? At the end, what's the actual confirmed amount? So we use the close. Now, based purely on that, let's go straight back to the start. So I have this nice peak, which you didn't know was a peak back then, right? So ignore everything you see here, right? And then let's move this line. So let's look here, down here. Let me zoom in and go, oh no, those two off. Here we go. So let's follow this, right? So we're in this line. You're looking at the chart like it's like this, okay? We keep going, we keep going, we keep going. It's going down a little bit. And here, after this candle, okay, I got this chat window in the way. Give me 1 second. Okay, so this is the first time the signal, as you can see, clears the volume. Right, you see how it's on top or in the volume here the whole time, and here it goes out? So that is your opening signal. So let's say you wait 1 more and you go in here. Now, it is aiming that the volume is decreasing, and the signal line is bending downwards with it, because it's obviously following it. What would be the indication of it wants to do without looking at this? Because obviously that's a dead giveaway, but okay. You already seen it, so it's a bit obvious, but who wants to take it? What do we choose here, a buy or a sell? What is it telling us? Everybody's saying sell, yeah. Without checking the charts. All right, but yeah, so it's a sell. So you keep following it and you can see exactly what happens, right? So let's take a second line and let's follow it. So let's lock in our sell. So we go in right here, right? Obviously my stop loss would be somewhere about above this line. Where exactly, I don't care, but above that line. So let's go. Sell, 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 sell. Oh, hold on. Here we see the first candle where the volumes flips from a buying volume to a selling volume. It's not here. This is where it confirms gets a sell volume. But this is the first time that the signal line goes back into the volume. So let's say you wait this candle out, it closes and it opens here, and it probably went down first, then went up and then pulled back, and you get this nice formation here. And again, price action, but okay. This is your closing signal when it crosses back into the volume. Now it happens to be here dead smack in the center line. It doesn't necessarily have to be there. Right? It can be later. So if you would have closed it, let's say you were stubborn and you were holding it, you would have closed it somewhere here. Right? Let's say you go out here. That was a pretty simple trade. But what can you do now? Well, we just went from outside to inside the trade. Right? So here, obviously, what you could do is close your sell and take a buy. And then you hold your buy. Again, you have your previous low wick, so you would put it underneath this line at least. So let's say somewhere over here. Let's hold it. So let's go for the second trade. So let's say we go out here, we go in here, let's say. And now we take our buy. Follow the line. We're in it. Whoops. We're in it. Oh, come on. What are you doing? Come here. All right. We took our buy still, right? We're in our buy. Volume. Whoops. Sorry about that. We're going in. So here it starts going outside of the volume from down up. We're in the buy. So we want the down up, right? We want the volume to decrease from the signal line. And we go back and we go back and we go back and we go back. And here you get a mixed signal. But here it basically tells you could have gotten jumpy here or here. But here we go back in where we go from a buy and sell into the volume. And this is basically where it's telling you it is time to close. Now, some of you are going to be stubborn and hold. Okay, that worked out this time. If you didn't do that here, you could have gone out here, but you went out somewhere over here, remember? But based purely on the signal, it tells you to get out here. Now, let's say you waited and you had your support line, your resistance line already, and it closed this candle after it wicked through here, you would have closed it here, or you should have here, because this should have sold, which is what it did later, but so you went out here. So you had, based purely on this one, trade number 1, trade number 2. Wait, come here. 60 down, 60 up. 120 pips. There you go. In, what is that? In 42 hours. Doesn't get easier than that, guys. But that's purely based on one indicator, which is obviously risky because they do get false signals. Let's try to find one. So here, for instance, it says, okay, so let's say we go back out. Oh, look, it goes out of the volume, which means we should sell. You're selling and you're holding and you're selling and you're holding. It didn't tell you to exit here yet. Still didn't tell you to exit. Still didn't tell you to exit. And here it went back in. So it told you to exit here, which is basically your starting point. So in sense, that could be a profitable trade. And if you would have used risk management and trailing stops and et cetera, it would have been a trading straw. Well, let's say you don't. You would have then hit your stop loss afterwards. So you lost a winning trade, basically, because it spiked too fast for it to keep up. Now, that could be a fundamental, that could be something else, but okay, so that's the MACD. So let's move on to the RSI. Now, the RSI is pretty commonly used. The relative strength index is, again, an oscillator, so it goes underneath. And the purpose of it is actually quite simple. It calculates the relative strength between two securities. That's it. Now, for those that are mathematically inclined, this is how it works. Line number 1, it takes 100 minus 100 times or divided by the 1 plus the average gain divided by the average loss, and then compares that with number 2, which is 100 minus 1 plus the average previous gains times 13 plus the current gain times the previous average loss times 13 plus current loss, and divide it all through each other. Now, for those that are mathematically inclined, you'll get this. For those that don't, it doesn't matter. But if you would be writing, let's say, your own trading algorithm, you need to understand how this stuff works. All right, but let's actually just slap it onto the chart and see what happens. All right, so let's do this all again. Get rid of those. Control I, get rid of you. I would like to keep my main chart. Thank you very much. All right, so let's do that. Now let's insert the RSI. It's an oscillator, relative strength index. Now the RSI, as a fun fact, it actually got developed in 1978, so it's fairly old. Now, because it gives you the relative strength, actually what we want to do here is actually we want the weighted close, because we want to know what is the weighted close of the high and low between two securities or two assets, right? In this case, the pound and the dollar, how are they relevant to each other? And we want to weigh that because we already have the other two. We have a close covered and we have a median covered, right? I hope that makes sense. Now, the period on average is 14. Again, the period means the last 14 candles in whatever time frame you're using. So if it's a day, it's the last 2 weeks. If it's a week, you're looking at the last 14 weeks. So don't do this on months because you're looking back a year and a half. If you're on 5 minutes, it's the last 70 minutes. Right? So that's the way it works. 14 is perfectly fine. Now, if you go in a high time frame, let's say you're a swing trader and you basically trade on a week, you wouldn't use 14. You would use like 5 or 6 or so. You don't need to know that far back because you have other analysis that you do for further back. But in an hour, 4-hour day, you would use 14. Maybe in 5 minutes, you would use a little bit more. But okay. Now, I personally add in the levels 20, 80, and 50. The standard default is you have 2 settings here. It's 30 and 70. Now, what you do is you just literally double click it, or you add, and then you add a line, right? In this case, we don't want that one. You initially are going to have this 30 and there 70. So you simply just click edit. And then instead of 30, you just take that out and make it 20. Click somewhere, anywhere, and then you add the 50 line, which is the middle ground. This is the color of your signal line. Make it whatever you want. I'll make fire break in this case. The scaling, don't worry about it. This is for some specific things like commodities maybe, or maybe crypto, where you want to have a much larger maximum and minimum value because they tend to overbuy and oversell a lot longer than usual. Because that's what you're doing, right? You're trying to find the oversold and overbought moments. But that is a relative term, therefore relative strength index. Right? Nothing is ever overbought. Just because an indicator says, yeah, hey guys, it's overbought, doesn't mean you can't buy more of it. Right? There has been one scenario where you couldn't sell more of it. Euro CHF. 2012. Look at the chart. Really funny. But so let's put this in. Bam. So we can already clearly see that this is a line above from top to bottom. Now let's zoom out a little bit. And you can see that this one's actually set fairly good if we back test it to where it says I'm oversold and overbought, because almost every time that it gets above this line, it flips. So basically, entry signal, the second it goes back through the line, so that would be here, and then hold it. Well, you probably would have gone out here, but let's say you didn't. You hold it, you hold it, you hold it, you hold it. Oh my God, massive spike. This is your closing. Now, obviously, it did another jump after that. However, you've made a solid trade if you went in a little bit late here and you went out somewhere over, I don't know, here. Still a solid trade with very little risk. What was that? So that is 79 bars. So 78 hours, let's say, for 200 pips. It's all right. That's all right. But let's say you did the other thing and you went out here because you went back to the 50 line. Oh, wait, this one's over here. So let's say it says go out here. Let's see if I can zoom in one more time. By the way, hi, Colin. No worries. Welcome. Glad to have you. So we go down and let's say you go back out here because this is where it crossed back over the 50. So you would have had your entry here, your exit here. It's still 37 hours for 60 pips. Now, some of you are going to get greedy, take a buy here, and you would have get snuffed here, but okay. Let's say you now say, okay, when it crosses the 50 again, because you didn't go to the overbought limit, you go in for a sell here. Because it, actually here. Because it closed underneath the 50, right? So it's getting momentum downwards again. So your second sale is here. Your stop loss will be above the previous wick, obviously. And then, well, we get this whole thing. And it says to go out there. Because we go through the 50. Now, some of you might have taken this one afterwards. Maybe not. But let's say you didn't, because our indicator didn't tell us that. It doesn't tell us everything, right? There's no indicator that's a perfect trading tool. It's a support tool. Remember that. You do a whole bunch of other analysis before you make this. But again, there's 150 pips, barely any risk. Small down draw, maybe what? What is that? 10 pips? 20. There you go. Right. So this is on 1 hour, right? So this is applicable whether you're trading on an hour, 4 hours, day, week, it doesn't matter. On 5 minutes, which we're going to try live later, you'll probably want to speed this up a little bit. And I'll do that with you guys today and see if we can make something happen. Now, that is basically the RSI. It's really straightforward. Oversold, overbought. When it's above the 80 line, I'm looking for sell. If it's underneath the 20 line, I'm looking for buys. Combine that with your technical analysis on a larger time frame where the majority of pressure is, you get the idea. So let's add the last one. So the stochastic. So the stochastic is basically what it does. It measures the closing price in comparison to its given price range. Now, here's the way. The purpose, again, is to find overbought and oversold moments in conjunction with moving trend line. So average, right? They're all, remember, this set all works with moving averages in one way or another, determining the trend, but also adding a little bit of volume and also buying, oversold, overbought moments, right? So this is why they work together. That's the purpose of stochastic, is basically one additional step where you look at the closing prices in comparison to the average, to the price range that you give it. So for those that are mathematically inclined, you get your percentage K, which is 100 times the close minus the low of the period, N stands for period, divided by the high of the range, minus the low of the range. And then your second indicator line is basically your three moving average percentage based on the first formula. Again, for those that are doing algorithms, that are trying to write trading bots, you would utilize this kind of aspects because this is how you would calculate them. Generally speaking, we don't know, but it's good to know that they have a little bit of a concept of how exactly it does what it does, because it makes you understand why it gives certain signals and when it doesn't. But you don't need to know this at the start. So let's get rid of everything again. Yep. Delete that. Boom. Go back to the start. Close that. Let's insert it. Looks like we might be going a little bit over the time, but I'm pretty sure nobody's going to mind too much. All right, so stochastic, we already said 14. Now, slow means how much more you shift it. So if I make a slow of 10, it shifts it by 10. It tries to extrapolate. Just leave that to 2. Don't worry about the rest. The rest is for maybe exotic pairs and stuff like that, where you want to slow down certain rates, something like that. Yes. And yes, Rule, it's being recorded. You will get it after the webinar. Now, K period, right? Remember, this is the long period that we want to take a look at. That's 14. We discussed this. We want to slow it by 2. That's the default. And the period, basically, as you can see, is half minus 2. It's funny, right? The other one was double plus 2, and this one's half minus 2. Right, so if I make this 28, this would become 14 minus 2, so 12. Now that's more relevant for those that do CFDs, like stock, or it would also be relevant for exotic pairs, where you have a lot more volatility and a lot of different movements at the same time. So you generally want to slow things down a little bit and have a little bit of a bigger picture there. And the method is linear weighted. So let's add that, and let's see how we can get the signals out of this one. So let's take the same scenarios again. So here, what Bollinger is saying, like, hey, look, I'm overbought. And you can see here where the signal line, here you can see that the signal line is crossing out of the other line. So this is the first confirmed candle. So this one's slower than the other 2 indicators, remember? No, not divided by 2. Half. So yeah. No, you're right. Yeah. Sorry. Divided by 2. Minus 1. Sorry, divided by 2 minus 1. Sorry, you got me there, Rule. Good one. Sorry about that. It's late. All right, so here we go outside, and we have the signal line going out of the other line. So here you can see the other one was giving us the signal here already. This one is one later. So you can see how they're different from each other. They do the similar thing, but this one confirms it later. And here we had the other ones giving us the sell signal here already, and this one said, no, hold it. And this is why in conjunction with each other, you're going to see later down the line, here we hold it, we hold it, we hold it. For some reason, this is squashed. And here it went all the way outside, so we have to use our other indicators. But we can just see the nip here where this signal line goes back through the median line. So it tells us to close here. Well, actually, it tells us to close right here. But it's a little bit under the system. If I zoom out, does it get it? Yeah, no. Right, so. But let's do the same thing here, and you can see it does react a little bit faster in some cases, because here it says, so let's say we take that buy again here, it told you to close that buy here, but eventually it still did it. So this one has more prone, and because this is more exponential, more prone to false signals. But here it tells us to go back in. We follow the line, it crosses, here it tells us to go back out. Right, so if you do a volume trading on a slower time, on a faster time frame, this would be preferable because you get more in and outs. You also get some false trades, but you get more in and outs. Right, you're doing volume. So what happens if we combine everything together? Well, this is the part where we're going to do something brand new. We're going to actually try to live trade right now. Because why not? What were we looking at? Pound US dollar. Right, so let's take a look at everything. Let me also do the. So we're going to actually use the indicators now. And we're going to do this in 5 minutes. I already set them up. This is also the same things again, the 200 and the 150. These are all on the default settings. I didn't speed them up because of the lower time frame, but let's see if we can make something work. All right, so this is a first try. I've done this on stream, but I don't know if we can do it in a webinar in 10 minutes. So what do we get here is basically the signal here is telling us Let's zoom in. We had our crossing. This is our fast. Got rejected on the fast. The slow is still moving. The average is starting to go down. This moving is just moved in and it just gave us the closing signal for the sell, but the volume is still going down. The RSI moved back up, is bending back off. It just got bounced off the 50. And it looks like the stochastic is now touching. They're about to cross again. Okay, so let's do cheating a little bit. That would make sense. So let's actually do a parallel. Yeah, okay, that's too far, huh? I hate 5 minutes. All right, let's see. I don't need the other lines. So that would be our range. See if we can quickly find. Oh yeah, there you go. So this was the previous high. This was the previous low, which is conjunction here. It's actually slightly converging. Get this. So this is a tricky one, actually. All right, so this one is not really clear, right? Because we have sell here, potential buy here, potential I don't know here, and this is not telling us anything just yet. So based on our technicals, we also are like in limbo between support and resistance. We're going down on a channel. You're somewhat high in the channel here, which would indicate a potential sell, but we're not getting that confirmation from our tools. So what do? You find something else. Let's take a look here. All right, let's see what we got here. Oh, signal line just crossed. For sell, that bounced off the 50. All right, so let's take a look at this. That's where it told us the signal. Sell confirm, bounced off of our two moving averages. And the volume isn't quite there. So this one is not telling us sell yet. It has the volume going up, but it started bouncing back down because these two volume lines are equal to each other. And this is going down. So this would tell us a potential sell. So let's do a little bit of, that is the bottom though. Can we extrapolate it all the way from here? We can. So our technicals now say buy, while our indicators say sell. So this is why I was saying you cannot, whoops, that's a little too squashed. This is why I said you can't rely just on the indicators. Because based on technical analysis, you would sell this, you would buy this. But they're all selling sell. Right, so don't really need to check it out. That's probably because of this. Yeah, because of that, it just bounced through that. Where's the next one? And it's 5 minutes. They're going to be close to each other. The next one's over here. So you would have a sell to here and then probably break back into the whole thing. So same story as the previous one. It's not clear enough. We have contradiction information. Indicators say no, say yes. One says no. This is a bounce. If you're in the sell already, fine. It might tell you to hold. But based on our technical analysis, we just really quickly did, probably not. So let's look at another pound pair. GBP, let's say CAT. All right, this could be interesting. Got rejection on the fast. They just crossed. The slow is starting to bend down as well. So this is going down. Now let's take an equilibrium channel in the last little bit. And we slapped, oh, that's perfect. That is a nice channel. Right, so from a technical aspect, we're in the top of the channel saying sell. This is starting to bend off as well. It just went in. It just went in to a downturning. This went off the 50, it's still moving. And this is a signal line moving towards. So it basically told us to sell here. So we're a little late for the show. But if we would go in now, your stop loss would be, your take profit would be there. So this one would potentially be a sell. You put your stop loss, you put your take profit on the previous low. That's a 1-to-1 ratio, but we know what the channel depth is. So factoring in the average angle. Yeah, seems about right. So this is what the expected trade should be. This will probably bounce up, go here, go there. We'll let that run. Let's find another one. GBP, or let's do something different. Euro USD, because everybody does Euro USD. Oh, okay then. All right. Okay, so let's see what we got here. We got pretty strong resistance up here. We're obviously going down at the moment, but no, we're very, very much going down. All right, okay. Yeah, so that's long down. Let's see if this is actually a channel. Based on the low, it's a channel that broadened itself. So let's take here the lowest in the same angle. Actually, that works. So here, that corresponds with what we're seeing here. It's telling us that this wants to start turning back up. This is not oversold, so this is unclear, but here the signal is crossing. So here you can see again, you have one on technical basis, it tells you this could be a good buying moment because it's been hanging around this level for, what was that? 1, 2, 3, 4, 5, 6, like an hour? Yeah, for an hour. Right, for an hour, it's been basically the same price, a little up, a little down. So that means that it was selling and it stopped selling, which means it's consolidating. It's basically slowing down, right? I'll show you. Give me 1 second. So this one is telling us a buy in 2 occasions, and on 1 occasion, it is almost at the oversold and it is slowly creeping up. So maybe, yes. What is this telling us? Well, basically it's still slowing down. We know that this is slower. So this is probably going to be bending off a little bit if it moves up. That moves with this, which means that if I go in now, I would take a safe bet. So I would take a buy. Obviously, you would put your stop loss. And the way that I do this, you just drag and drop your stop loss. Now, you can take it safe. You go in here, but that means you're still in the channel. So it can just very freely go like boop, down and then up. So you want to be outside of that. So let's say there. And then you put your take profit in. Again, 1-to-1 ratio. It's not great, but you would basically aim for this because you expect this to bend off. It will probably hit somewhere over there. If we look at the average angles that these guys go, this one was a bit slower if it's longer. This one's way slower, but it actually didn't go up. Slightly corresponds. What is the previous one's doing? Yeah, pretty much. Right. Okay, so let's take that as an equation. Yeah, that makes about sense. So we let that run. Now, if you want to do it safe, what's 50% of this? 56 points, trailing stop. Well, let's do 55 points. There, done. Okay, don't have to look at it anymore. So let's do our terminal. Let's see what we got going on here. Oh, we're losing everything. No, just kidding. All right, let's take a look at another one. Let's see if we can find something that has an even clearer signal right now. Guys, throw some suggestions. You want to see a specific pair for some reason. Let's do the SP 500. I don't know how they have it. Bugger. What do they have it as? Forex all. What? That can't be all of it. Show me. Why can't it show me everything? Show all. There we go. What about Apple? No, I don't want to buy Apple. Yikes. No, I hate trading on 5 minutes on this stuff. Oil, cat CHF and oil. What is everybody with oil and gold? All right. I'll pleasure all of you. All right, so definitely gold would be in and out. Jesus Christ. Okay, so with gold, you wouldn't even bother at the moment. It's literally going sideways on this price level. Like if I go in here, I could have been waiting 3 weeks and I'm still here. Yes, I know what some of you say, but we went up there and then we went down here. I can trade this one and that one and this one and that one and this one and You don't do that. Let's be honest. You're basically bouncing between this, roughly, and this, roughly. So whenever it's down here, you buy. Whenever it's down up there, it sells. If you do that every time, the only time you're going to lose is when it actually breaks it. Like here. Big deal. You win 7, you lose 1. All right. So gold is kind of like just moving sideways at the moment. Okay, cat CHF. Christ, guys. Cat CHF. All right, let's take a look at cat CHF. Ooh, this could be interesting. Okay, what is this? 5 minutes? 5 minutes. All right, let's go to an hour. Oversold, oversold, or overbought. Sorry, my bad. It's still high, very, very much in the volume. So this needs to go out first and then sell. So yeah, this would probably be a sell in a buying situation. No, it's actually going to be a sell in a selling situation soon. So this could be a potential swing trade, right? Because this looks like it's about to hit that resistance and then potentially pop off. Because it's already been overbought for quite a while. The RSI is catching up to the stochastic. This is also flipping. Now, if we look at previous levels, it can go really, really high. So this could push past the previous point, but let's take a zoom out. That's quite a bit to go. So if we take the wicks and everything in consideration, this would be the ceiling. Yeah, you would probably do something like this. Wait, why is this on? So let's whoops, did I just open 2? My bad. You would do something like this. And then this is not trading advice, guys, just to make sure that everybody understands that point before I get sued, stuff like that. We're just looking at how indicators are telling us things, right? Factor in the angles. That's pretty sharp. Actually, it just moves down that sharp. Jesus. All right. So something like this. So your take profit would be there. There you go. Now, our indicators are showing that this is potential sell. We just went in a bit early. But I'm factoring in the previous wicks, hoping that it will stay underneath that as it should. So I don't care if it goes like up here and then go back down. This does not make me sweat. Because the only time it's going to hit this if it actually breaks what it hasn't done since May. Right? It would actually have to break May levels. It's coming from a lower point. Well, actually, May came from a lower point. It's coming from a, let's see, low, lower, low, high. Okay, but even if you would do, okay, let's add some other factors here. I don't know, Fibonacci retrace. This has been consistently going up. This is crossing, that's crossing, this is showing up. This has got to come down for a bit, even if it's a pullback. So where's the thingy? Fibo, where are you at? Fibo. Wait, didn't they have, here you go. So let's say we have this. Now we have to factor it based on that because that's the only thing we have. And I did it the other way around because I'm an idiot. I want the, oh yeah. No, I'm going to have to factor it from there. So let's say that's going to be 100, and then this is going to be, yeah, pretty much pull back to 38.2. Remember, 100 goes back to 38.2, maybe 23.6, but now we're adding other stuff. So anyway, CAT CHF. Based on the indicators we're seeing, it's getting to overbought, so we'll probably turn. Stochastic is already ready for the turn. The MACD is not quite there, so you would wait this out, right? If we look at an hour, similar thing. So let's say you do trade on an hour. You would basically wait for this to actually flip, confirm down, and then you would just take the sell, and then you would probably, because you're a smart person, factor this line in and take your sell to there, not to what I did, because this is long term. Your short term would look something like well, let's say it's already above the previous high. So let's say you take it like this. Why is it not working? Whatever, doesn't matter. And then you factor in these previous lows. Why is this not doing it? Well, whatever. Where's that GBP cat? Oh, this is the 2. We have 2 open. Let's do 1. There we go. Now it works. So you factor this one in and you factor that one in. You would have something like this based on these indicators, because the indicator will tell you if you need to go out premature, but if it hits your take profit, it hits your take profit. You don't need to go out if it hits your take profit, obviously. I hope that makes sense. And obviously a bunch of you have like these questions about, hey, can you do this one? Fair enough. I set myself up for this one. So yeah, fine. We'll just do a live stream. USD, what about Bitcoin? Well, all right, so here's Bitcoin. I predicted both crashes correctly, so I'm going to tell you what I think is going to happen next. We're going to go back to 62, maybe 65, and then it's going to have another halving period back to about 40. Then it's going to climb to 80, where it's going to hit its 3-year halving mark, probably, and then go back to about 20, and then it will go to 150, give or take. The real value of Bitcoin will probably stop around 200K. But that is heavily dependent. Remember, every 3 years it has a halving period. So whatever it's going to be in 3 years from now, take half. And that's where you go back in. But there's a few very, very dangerous factors about the whole crypto thing. One, if the group or founder of crypto, I should say, of blockchain reveals who he is, or she, shouldn't say too much, then crypto will drop like a brick. And obviously the biggest problem with crypto at the moment is adoption rate, right? Look at how imagine that Bitcoin is worth $100,000, right? Just follow me here, guys. You go to let's say supermarkets now also accept Bitcoin. You go to the supermarket and you buy for a month's worth of supply, let's say $500. I want to pay in Bitcoin. Oh, sure. Can you have back from 1 Bitcoin? What store holds $199,500 to give you back in cash? So you would have to bracket it and be able to trade 0.00001 Bitcoin in order to pay your $500 bill. Like, that's not viable, because you will get things, if it would become randomly adopted like that, you would also have to be able to buy, I don't know, stupid things like a pack of bubble gum, right? Because then it becomes an accepted currency like every other currency. So now all of a sudden something for $1 and you're paying with something that's valued at $200,000. Like, you'll spend 10 minutes typing in the correct number behind the comma in order to pay. So crypto or Bitcoin itself, I mean, blockchain is going to stay. If crypto is going to stay the way it is, I don't know. But we can slap it in here and see how indicators react to it. The problem with Bitcoin is obviously it's more supply and demand, and it's very speculative. But so let's do Bitcoin US dollar and let's put it on a day. Can you use it? Well, you see that it worked here. It hit off the slow moving average, knocked it. This is a median. The slow is over here. Right? It got rejected. It went through, got rejected, went up. The volume, well, look at that. It actually worked. Obviously, Stochastic doesn't know what is going on. This is a problem, RSI, because there is no relative strength, really. It's speculative, like I said. There's a lot of factors that go into Bitcoin. Here, it basically went out and told you to buy. Well, you would have been in the buy now. In a weekly chart, close, and here it goes into the first time. So buy here. It's also where it crossed to the 50, and it's where the signal line went out. So actually, yeah, it worked here. It actually worked perfectly here. Yes, for everybody that's asking, this is being recorded and you will get the recording. You just won't have the Q&A session on the recording. No, wait, for those that attended, we'll have the Q&A session, which we'll get to in a second. Okay, so let's take a look at the things that we opened. Let's see if we did anything decent. Nope, we're basically at 0. So let's take a look at this one first. Where are our indicators going? We went in a bit early here. Hold on, I got a whole bunch of stuff on my screen with the chats and everything else. So give me 1 second. And let's just take all that out there. So here we are seeing that now it's starting to tell us basically to sell. This is still not quite there yet. So we went in a bit early with this one, right? But it still tells us the same thing. It'll probably bounce off of this, get close to our stop. Oh, wait, our stop loss a little bit too. Should be there. And our take profit's probably going to be somewhere over yonder. I'm just looking at these previous levels here, something like this. All right, well, I'll let that run. Maybe during the Q&A, we'll see what happens. So the euro US dollar, we're in a week. Let's go to 5 minutes. That would make more sense. Let's go back to the first one as well. Yeah, all right. What did we do here? Did we buy or sell? We sold. So yeah, we're just waiting for this to turn again. Up didn't work. It's going to sell. This is probably going to cross to this, going to go down. And now I obviously put this completely out because I was looking at a week because I didn't notice, I wasn't paying attention. See, everybody makes mistakes. This is really tight. We'll put it about the previous high. And then we'll put this at, this seems like a pretty stable resistance. We'll put it over there. Right, so basically we're expecting it to do that. Let's take a look at this bad boy. Oh, there you go. That's your buying signal, right? This is the one that we were talking about. It went through that signal and went just out. We missed it a little bit. We would have been in this earlier. This is now crossing the 50 going up. This is up. It's already going. And I think the trailing stop's already active. Yeah. So here is, right. So this one is already guaranteed to not go red anymore. Our trailing stop's already active. So this is literally, we cannot go red. I mean, we might go 0, but we can't go red. This will probably bounce in the next 10, 15 minutes, like hit that. We'll see. And then we have this one where, again, we went in a little bit premature, but we have a signal selling sell. This is this a sell or is this a buy? It's, did we just lose one of the trades? Oh, no, it's right there. Never mind. I'm getting blind. Call it age. Yeah, so this one's slightly to bounce. So this one could bounce off the 50, but this one is telling us sell. This one's not telling us or anything. So this one we went in a bit early, but based on other factors, looks like a good potential selling moment. I think we did one in an hour. No. And an hour says buy, 5 minutes says sell. Like for an hour, I would buy this. For 5 minutes, I will probably sell it because it'll probably pull back and then go for the buy. But I could do it now. We just went in based on the indicators a little bit early because this is laying on top. This is crossing through. It depends on how this candle closes. Right. So obviously we can't like go through the whole thing, and we went way over the time already. Sorry about that for anybody that had to leave. We'll leave it there for the recorded part of the webinar. So everybody that is leaving now, I'd like to thank you very much for joining us today. Appreciate you coming. I hope this was helpful, and I hope to see you on the next webinar. Now, for the people that are staying, now we get the fun part, Q&A. So now I can actually shut up for a second, and you guys can just throw stuff at me. So yeah, guys, Q&A and ladies and anything else you identify as, throw away. What kind of questions you got for me? Oh, let's keep the charts open to see how these things develop, just in case something fun happens. Or maybe I lose all three. Oh no, I can't lose all three because this one already has secured. All right, first of all, somebody's asking about oil. All right, so let's take a look at oil. And now my question is, how do they have oil listed? It should be listed as obviously thingy, but where is it? Where's Brent? Brent. Oh, let's just type it. Brent. Does that work? Hey, it works. Sweet. All right, so Brent oil. Let's take a look. Now, first of all, if you followed other webinars of mine, commodities is not something you trade on slow time frames. You don't trade them on an hour or anything less. You trade them on a day, 4 hours, maybe. Now, here you actually got a perfect example. We're crossing, so it's going in acceleration, still going up, so it's still holding strong. Let's take a look at a week, just purely based on the indicators. Well, it's getting to overbought levels. Let's take a look at a month. Oh, that's why it's overbought. Previous high. There's probably a bunch of pending sell orders right about there. What price level is that? 86? Yeah, so at 86 sharp, because we are all problematic with OCD. So all pending orders are going to be here and take profits. So a lot of them are going to hit here, and then it's probably just going to bounce down. Now, keep in mind that oil is not like other things. Oil obviously is very, very depicted by supply and demand, meaning in the winter, well, actually pre-winter, which we just passed, demand goes up. And obviously the oil companies do something smart, is they put the production down. So less supply, more demand, price goes up. Because everybody needs oil in the winter, they don't need oil in the summer. For fuel. But obviously plastic factories and stuff like that. For metals like gold and stuff like that, same as is like a commodity, right? So you generally want to trade these on a longer time frame, and they're generally also not a good idea to trade if you're on a small account. So anything under 5,000, I would avoid commodities and metals. Stock maybe, but the reason for that is because they move very big amounts in short time frames, and they have long runs, so they're very good for swing trading. They're very good for long-term trading. They're not that great for if you're trading 5 minutes, unless all you're doing is trading with the trend. But you can see here how sporadic it jumps around. Like this is really hard to trade on because you're literally just jumping all over the place constantly. Like look how the volume switches. But if you look at it this way, the volume doesn't switch that much. So they're more stable and safe to trade in longer time frames, because keep in mind, this is also a few thousand pips. There's 2,000 pips actually. Now, you can only trade this on a mini lot minimal with any broker that I've known, but that is also the 10th of a value. So technically a mini is a micro. However, your stop loss is also a thing to consider, because you need big stop losses. If I would trade 5 minutes, if I would take a, let's say a sell right now, my stop loss would at very least be underneath here. Which also, but it's already in range because it can go from here to here easy. So if you were to do the safe bet, your stop loss would be all the way down here, which means that for a risk management level, your take profit would have to be double at least. So you would be looking somewhere over here, which is fairly ambitious, considering that you've literally been bouncing with this high level and the average this low level. So I would buy it here, sell it there, buy it here, sell it there. Like that is how you would trade this on a smaller time frame, but I really don't recommend it because if you look at this, like now you would sell it, stop profit, stop loss above that. But if I go to a day, you get a different view. In a week, you actually get a sell. But that's already a 500, well, it's actually only a 50 pip stop loss because we're really, really high. But that's under the prejudice that it does turn. So a swing trade, technically. And then you hold it for several weeks up to the average median, which would be somewhere around there-ish, give or take. So this would be like perfect entry because your stop loss is going to be just outside of this. So your stop loss would be here, your entry would be here, 4,000 pips to 70 pips. 400 pips to 70 pips. Right, so this is how I would put that one, basically. Yeah, I know WTI, but I did Brent. I was looking for WTI, couldn't find it. Is it in here? Oh, it is. I'm flipping blind. Thanks, Will. Hey, well, yeah, they have it under. Yeah, okay, they're equal at the moment. Whatever. Right, so, but same thing, basically. Whoops, wrong one. Where's the chat? Oh, here's the chat. Right. Okay, I'm gonna get to everybody. Just have some patience, please. How do we change the candlestick color? Oh, okay, that's easy. It's not really on topic, but you go to properties, and then here you will see colors. That's or you probably end up here where you go to colors, and then you can just say bar up and bar down. That's the wicks, and then the candle is the actual color of the candles. Just make them the same, otherwise you get wicks different colors than the candles. So you literally just right click your chart, go to properties. Or when you're on a chart, you press F8. Right, that's on MT5, by the way. All right, so can you please explain the divergent convergent basis RSI? Oh, right. Do we have time for that? No. I'm sorry, Chesney, because basically what we're gonna do is, okay, so when you're looking at the RSI in general, right, there's no real difference between the normal RSI and a divergent and convergent basis of the RSI. When you're looking at like technical drawings, if that's what you mean, if it's a converging or diverging RSI, so in this case, we have like a channel upwards. If we look at, oh shit, I have to go to something else, hold on. Let's go back to an hour. No, why did I click that here? I'm stupid. Here we go. So here we just have basically horizontal moving, right? We don't go anywhere. Now, I assume that's what you mean. Unless you mean something else, then please do correct me if I misunderstood your question. But you can do technical analysis on your chart, on your indicators as well, guys, to indicate trends, right? So you can find, for instance, let me zoom in. Can I make this a bit bigger? So here, one thing you could look at is, okay, we have a bottom trend here, but at the sometimes at the same time you have a higher point, let's say this one, and you go there, right? So this one would be converging somewhere over there, let's say. If that's what you mean, Shashi. If not, then please correct me and I'll explain it otherwise, but unless you mean a completely different indicator. Can we find daily? Yeah, but I can't go into that now, Colin, about daily pivot points. That's completely topic on its own. Yes, the recorded is available for people that joined late. That'll be fine. We covered. Okay, so what about Bollinger Bands? Okay, so let's throw that one in there real fast. Bollinger Bands basically give you a range idea, right? So 4 hours, insert, indicator, trend, Bollinger Band, boom. So again, it's trend. This is fine as default setting, unless you're doing something specific. But basically what it's telling you is that when you're in the bottom of this range, it should go up to the 50. If it breaks through, it goes to the top side. Now, Bollinger Bands has bottles and a bottleneck and an opening. So we basically call it a bottle. Whenever the neck is closed, it will, without doubt, spread open next. And you can see that everywhere. Closed, open, closed, open. Well, this one didn't really close because it kind of like bent down. Close, open. Perfect example. Close, open. The problem is you don't know which direction just yet. In this case, you couldn't know the direction because it was at the bottom of the neck. So you take a buy. And then, well, this one, obviously, we have to tweak it a little bit because it seems to be a little bit too insensitive. So let's try 16, a deviation of 1. And let's do the high, low, and the close. No, that makes it too slender. I was afraid of that. Okay, so let's make deviation 3. Yeah, just high, low, I think. That's better. So as you can see, you just play around with it a little bit. There you go, presto. Now you got the right setting for this one. All right, so let's see. Bottom of the neck, rejection, buy. It hits the top of the neck here, close. That simple. Right, so here we hit it. It says basically buy, you're at the neck. It stayed, but let's say you already won in buy here, right? You had your previous low. Yeah, it's a bit tricky to tell actually. Because this on this 1 hour, you would also have this trend line. And you can see why I said pick the information you want, because right now I can barely see my technical analysis because I got so many lines on my screen. So let's do this in a clean, God damn it, clean chart. Trend, Bollinger. Yes. Zoom it out. There we go. So we just missed the buy moment. We just missed the sell moment. So right now we're waiting because we're at the median line, right? But yeah, Bollinger Bands. In simple terms, whenever you're at the top, you sell. Whenever you're at the bottom, you buy. In the neck. So if you would have sold here, this is where one of those examples where you have a false signal. It's in the neck. You sell it, you go down, and then it decided to push for a new high. But that's why you have your technical analysis as well. It's yada yada yada. Sell because you're in the top, made to the median, it's stuck, you close it, goes back up, sell, goes back up, sell, go through, stops, hit the medium, you close it, or you hold it, and then you get profitable here. It has quite a few false signals, so you do need to do technical analysis on a few other aspects. Bollinger in itself is not enough. I hope that answered your question, Najma. Alyosa, what do you mean by why not a small time frame? I think you mean that. I think you asked that question when I was talking about gold and things, so I answered that one. Best time frame to trade metals and gold. I answer that question. Generally speaking, you want to look at following the week and the day, but opening or executing your trades on 4 hours or an hour at best. But you want to trade on intraday to weekly. Generally speaking, you generally don't want to do 5 minutes because it's way too volatile for that. Like it flips every 2 minutes. I mean, not saying you can't do it, but you would have to specialize in it. You really need to sit down for it and understand when the time of day. You need to follow the stock market. You need to follow the production news. So you need to know what's going on in South Africa with the gold mines and stuff like that. That's kind of how you trade these kind of commodities. You need to really follow the entire supply chain if you want to do proper gold and oil and stuff, which is doable, but you know, like I said, you just have to sit down for it. I can ask, so what were the periods that you used for the moving averages and what did you apply it to? WSA, oh, was it exponential? And did you use any shift? The answer to is no to shift. And the periods are 200, 150 on a simple moving average because I combined it, right, with MACD, RSI, and stochastic, and both the MACD and stochastic have an exponential moving average and a slightly different. So this way we have a good mix of slow moving averages, simple moving averages, and exponential moving averages. So we look at both trend and volume and overbought and oversold levels at the same time, that they all do a similar thing but slightly different. So we try to find false signals by comparing it to other ones that, you know, the signals should all be in line with each other. Let's see if this trades did anything yet. Okay, we lost one. Which one did we lose? Where is it? Is this one? Hold on. Time. Did we do the cat CHF? No, cat CHF is still there. Oh, that's the one we closed manually. Never mind. I'm stupid. We had 3, didn't we? Which one am I missing, guys? Oh, was it the GBP cat thing? Yeah, okay. So the GBP cat did do the long-term thing and went for the buy because we went in a bit like wonky on that one. All right, so that's fair. Now this one, right? So here you see it nipped. So importance of stop loss calculations. Aha. Oh no, wait, I was looking at the wrong. We did it on 5 minutes. So yeah, here we're in. It's slowly moving. We didn't set up trailing stop here because I'm bad. I know that's 14. So the trailing stop here would be what, 5? Can't even do that. So 10 points, whatever. And then this one is still kind of just like, oh, I almost hit the trailing stop, but I didn't. So yeah. See, the stochastic is now telling us to close it. While the RSI is also bending back down, but the MACD is now telling us like, okay, I'm ramping up, which makes sense for us, right? It's probably going to do this, up, and then down. So maybe we made the trailing stop a little bit too sensitive, but for the example, whatever. We'll just leave it running while I look at the chat. I hope that answers your question, Ekin. How could you analyze a previous period of candlestick where the price includes sell, but all the indicators are otherwise, vice versa? Okay, so basically that's 2 webinars on its own. The one is price action, the other one is this one. Basically, if you have your technical analysis, which price action is part of, but let's say you're close to the bottom of a channel and you're at a resistance, so you're at a double resistance, or at the bottom of the channel and at the resistance in a downtrend, let's say. And 3 of your indicators now say buy, your technical analysis says buy, 1 indicator says sell, and you just see a rising star develop. The second that the rising star closes confirmed, or an engulfing candle, whatever it may be, you now have a last signal telling you like, okay, I am going to turn now. So now you have 4 telling you yes and 1 telling you no. It's barely ever that you're going to get all of them to line up perfectly at the same time. So you now take just the weighted calculation in your head, like, okay, I was thinking a buy, it's technical analysis, it's a buy. There's no fundamentals coming up in the next 24 hours that could screw with my trade. We'll factor that in for a second. Risk management wise, my stop loss take profit ratio would be perfectly fine. It's 1 to 3. I can trade this with 3% risk on my account because that stop loss is in range for me. Perfectly fine. Okay, I'll take the trade, close it. right? So you take the buy. So it's literally what you you have to use your common sense to analyze all the information you're having and then put them against. But if you have three of them conflicting information, let's say three indicators tell you a buy, one indicator tells you a sell, and your price action also tells you a sell, and your technical analysis is telling you sell, then obviously you do neither because you have three buys and three sells at the same time. So basically you have neutral, you have zero. Now, unless you are really convincing yourself to do one or the other, then you're just making a judgment call for yourself. But based on purely the information you're getting, you should basically not act and just find something else to trade at that moment, depending on the time frame, etc. See, if it's a day, you can wait a day. Right? If there's no fundamental analysis, no fundamentals coming to screw with the way that the market moves, then it's usually a safe bet to just wait. What's the highest price oil could reach at the moment? By the way, I hope that answers your question, Louis. Oil, which one, Brent or WTI? Which one you got? It doesn't really matter actually. You bought at 69. Wait, what? Where? Oh, wait, this is 5 minutes. I'm like, why is that so far away? Well, that'd be why. So it's probably WTI then. Well, you're basically at the level, right? Look, if we look at a week and we zoom out a little bit, market price, you're basically pushing against this level of 84. If we look, if it's Brent instead, right? Brent is currently at the previous high of, what is that? 2018. So that's probably going to be a lot of take profits there and stuff like that. So the volume will probably flip. So you can either hold, take a hedge, or close the trade. But it's probably going to drop back by half and then go up, like, you know, do pullback and then continue. But there's going to be a lot of pending orders and stuff like that for sell soon. So yeah, you're pretty much at the max. If you're looking at what price can it really go at, yeah, they're hoping for $100 a barrel again, but I don't think it will. Probably 80, like 80 or 90 here. 95 maybe, but we're already pushing the limit as it is because this is all pushed by the high demand right now to stock for the winter. W2I, yeah, 95, I think, like something like this. It's basically the medium price here. It's a pretty safe bet. It could shoot back to 100, but oh, that's going to make the market really sore. Oh, I need to drink some water. With the whole pandemic and everything else, pushing market prices that high could happen because of supply demand issues. But it will also mean that a lot of people are going to, yeah, I don't think that's going to affect the market. Yeah, people are going to tank, you know, put less fuel in their cars, but that won't affect the supply that much or the demand, to be honest. Because you are still going to go put their pre-orders in, they're still going to stock up. So yeah, 100 maybe. But I would say, take the safe bet 95 is like roughly the peak. But you're first going to get a pullback in the next $10, something like that. Just from market movement, that would make sense. Sorry, I'm starting to get a bit of a dry throat. Any book suggestions? I always get caught off by that question. By the way, I hope that answers your question, Yolita. Any suggestions for a book? Warren Buffett's book is good, but that's more about mentality of trading and mentality of investing and stuff like that. It's setting expectations. Forgot what the name is. And the other one is The Value of Money. I think it's called. I forgot what the author is. I don't have it at hand here. But it explains why markets do what markets do, basically, what money really is. It helps you understand why market movements make sense, even when they look like they don't make any sense. I hope that's, sorry, Max, I didn't have better. I need to think about this for other webinars, just prepare a list of books. Because I get that question sporadically and not that often. I'm sorry. How to set up the trailing stop? Okay, well, simple. You go to your trade once you have it open. This only works in MT5, by the way. Not on like, wait, we were on 5 minutes here. There we go. So what you do is you right click your entry and you just go to trailing stop. Now, keep in mind, this is in points, not pips. If you read this in pips, this is 1, 1.5, 2, 2.5, 3 pips, 4 pips, 5 pips, 55. So if you do an hour trade, right, and you are like 100 pip take profit, so 1,000 points, a 500 point stop loss, the average daily ratio is, I don't know, 30 pips. Then you would take 30 plus 20%, it's like 350 points. So 35 pips would be 350 points. You would basically right click your entry, trailing stop, custom, and then points, you would make 350. Then your trailing stop will be 35 pips. You just take the last digit off because this calculates in points, but we don't use the micro pip in retail trading. I hope that answers your question, Renee. Okay, well, if you have to go, you have to go. I'm glad you were here. I hope you enjoyed it. Oh yeah, when you do a new chart, somebody asked why does it always open a new chart. It's just the way MT5 is. So if I would, what now? Stop it. So if I do new chart, it always opens like this. This is just the way it used to be in the past. It's obviously really outdated. You just go color on white, and that's a good start. You boom, there you go. Press Control G to get rid of that stupid ass grid. You're done. If you like the grid, use the grid, but it generally tends to confuse people. So basically what you do, I'll redo it, close the chart, new chart, right click the chart, properties, color on white. By default, it's white on black with green and red. Done. And you can make it different colors. I have one person that is colorblind, so they have, I think it was orange and something else. If I'm not mistaken, but yeah, they have different colors. Okay, so somebody questions, what is divergence? So divergence is when, if it has different meanings. You have a divergence of volume, you have a divergence of trend, but if we're talking about a trend, for instance, I don't know if I can find one real fast, but okay, let me take this squiggly stuff out of the way. Let's take this for a second. Here we have the chart going this way, and let's say the chart is going here. This is converging. The two lines are going towards each other. If I would have this, and come here, work with me, and this, let's say, something like that, is now diverging. The lines are going away from each other. So that's converging versus diverging. Yes, take care. Okay. I know we don't have any time anymore for Ichimoku. I'm sorry, Rainier. Send an email to webinars@legacyfx.com. I'll send you a written explanation, or I'll record something for you. I don't have time for it in the webinar because we're already way over the time. The replay will be available. You get the recording. Basil, right? Oh yeah. Right. Duty says thank you. You're welcome. You're welcome. Just showing. Does MT5 have position size calculator? Does the calculator give a good indication of the risk reward you take? No, Johnny, it doesn't do that because MT5 is literally just. Oh Christ! I really need some water. Sorry. No, there's no risk calculator as what you're referring to, like the online. I'm not going to mention it, but that calculates the risk because it doesn't know your factors that much. You have obviously your margins and your things here. MT5 stems from an older system. It used to be MT4 in the old days. You do have, you can set it up. Hold on. They might have added it, actually. I don't think so, though. No, you have to use a third party for that. But your position size calculator, honestly, I've never used a calculator for that because I just do it in my head. Because I just, basically what I do, like if I want to calculate the size of my lot versus a trade, let's say we have this trade, right? So let's say I want to take a buy. I'm really late to the party. This is the lowest point before that. We have the wick, so my stop loss is going to have to be here. Let's be really ambitious and say, well, the take profit is then going to be, because I go in here, my take profit would have to be double that. So roughly around that. It does make sense, actually. That's 300. This is 24. Yeah, it's a little bit more. So let's go, let's be ambitious. Let's go for the previous high. Okay, let's take in this scenario, I have a $1,000 account. I want to take 3% risk per account. If it is with the trend, blah, 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 but let's say 3%, so up to $30. This is a 24 pip trade. So on one mini lot, it's $24. I can take a little bit more, about half. So this would be a trade that I can open at 0.15. And I just buy, boom, they're done. All right, so my stop loss here, it now says, as I take the lines away, come here. Oh, come on, work with me. Minus 37.5. I overshot a little bit, but okay. I might take profit, and then now I care. Okay, I make 50. So I'm risking 30 to make, or I'm risking 40 to make 55. Right? Look at it that way. Huh. Oh, it does allow me to. Okay. Whoops. I shouldn't have done that, actually. Oh, it doesn't matter. That's these two. This one's still going, actually. Huh. Look at that. So we are guaranteed to make a whole 15 cents here, guys. Woohoo. But anyway, the indicator worked. That was the point. So this was where the signals lined up. Did we do it here? Yeah, we did it here. Right, so all the signals were basically telling we're going to keep going, and we went in and it worked. So let's see here. So Max says winter is coming, so the price might go up. I'm assuming he's referring to the oil thing that we did. Yeah, but keep in mind that during autumn, the winter prices are already factored in because the orders are coming in about 6 months before the actual period. Oil is not exactly what countries buy on a sporadic buy. It's pre-planned. In the summer, they buy for the winter. In the winter, they buy for the summer. Almost. Slightly shifted. But right now, they're buying for February, basically. Can news push price? Yes, it can. I did a webinar on fundamental analysis. It definitely can push price, much less than it used to in the past, but yes, it can. It depends on the drivers. What's more noteworthy to know about candles? Well, if you're going to use candles, I'll also add specifically noteworthy to know about candles is candle patterns or price action. Basically, right? Renee, thank you. You're welcome. Mike, can you check AUD JPY? All right, fine. All right, AUD JPY. I'm looking at a week because I always start there. Oh, that's showing some potential buying. We're a bit late to the party, though. Jesus Christ, this service slow. Didn't say that. Shh, I might say. Oh, this looks almost like it's creating a channel. It is. It is making a channel. Well, that's a buy. 2. You got that here. So factor in the average angles. And this is a little bit less, so we'll take a median. There you go. Buy, stop loss here, take profit there. You're welcome. Don't take that as exact trading advice. Again, officially, I don't give trading advice. But yeah, that's what it looks like on a week. So on a day, you get the same idea, but you get a little bit more playroom. Then we go to an hour, sell now, buy later. So basically when the indicators are telling us sell right now, right? But we know that in the bigger picture, it wants to buy. So if you factor in risk management, you would take sell at 1.5% risk if you normally take 3% risk or 2% risk, whatever you want. And then when you are done with your sell, so you close that earlier, keep it at 9, use a trailing stop because it goes against the trend, and we generally want to trade with the trend, right? Don't say trend is your friend because it's not, because it can screw you over. But trades do have a tendency to run longer if it's in the direction of the bigger picture trend. I know, odd, but it's the way it is. So you generally just trade with the trend, period. Especially when you're a small account or you're starting, be patient. You don't need to grab every possible turn and pivot point. Just trade the solid moments. Wait. There are so many instruments to trade. And forget about commodities. See if these SP 500, Nikkei, the DAX, stuff like that, sure, but not individual stock. That's a completely different story. But trade the majors and the minors if you're a small account, so up to 1,000. From between 1,000 and 1,500, you can add maybe an exotic or a CFD, one in the entire portfolio, because you want to control your exposure to volatility and you want to build a consistent trading account. You don't want to get rich tomorrow. I know you would like to, and there's people that have done that, but if that's your attitude, then quite honestly, take all the money you have, go to the casino, put everything on black 18 times in a row, your odds are better. It's just the honest truth. Like trading is slow. Like the first 5 years, you barely see anything happen. You have a small account. A small account is not going to turn into $50,000 next year. When you get up to a certain level, yeah, it starts speeding up because if you're using a percentage system, which you should, the number you're trading gets bigger, but percentage-wise, you're taking the same risk as always. And because it's risk of the new 100%, your risk downwards is always less than your risk in growth, which means you exponentially grow. Anyway, that's a whole different story. But yeah, variable lot sizes, definitely use that. Don't use a fixed lot size because in the long run, it doesn't work. Or it works less, I should say. Where's my Q&A? Oh, there's my Q&A. I need to go. Have a good evening. All right, Pedro. Well, you already left, but thank you for having. WTI 4-hour chart showing divergence. Yeah, okay, maybe. Did I just do that in 1 hour? I did not. Oh. Is it? Well, yeah. Okay, yeah. So yeah. Well, You got a pretty stable bottom. You just don't have a stable top. Well, does it? Slightly, not much. You're basically in a channel. Slightly above. But yeah. Okay, where were we? Let's see. Thank you. If I can't attend for next webinar, I suppose I'll have it as a video. Yeah, Max, if you just register for the webinar, you will still get the recording. Now, I'm not sure if the recording that Legacy sends is with the Q&A or without the Q&A, because they usually edit the Q&A out for YouTube. So I'm not sure, but I think if you register for the webinar, you get the full one, and the ones on YouTube are the ones that they take the Q&A part out. Because, well, usually it's also very off topic, as you can see. Engulfing candles. Okay, Ayosa, for price action, and for everybody else that wants to know price action, if you go to YouTube, you go to type in Legacy Effects, there's a bunch of webinars I've done for them, including technical analysis, 3 parts, indicators included, but the first 2 parts are drawing your technicals and the rules about that, and then entry and exit points based on those, fundamental analysis, price action, risk management, and a bunch of other stuff that I can't even remember, but they're all on there. So YouTube, and then you go to Legacy Effects, and then you'll find them. Price actions on there as well, Alyosa and everybody else. So that's where you can see candle patterns, and I discuss a few like Rising Star, doji, gravestones, dragonflies, all these kind of different candle patterns that you can put on top of everything else already. Which also asks questions. Rainier's question. Yeah, so that's yeah, the previous webinars. YouTube, type in Legacy FX, and on their page you'll find a bunch of other ones. How can you use awesome oscillator indicator? Okay, Ganesh, I'm sorry, but I don't have any time left to go into that. We're literally 2 hours into the webinar, so we were like way over it. I'm sorry about that, Ganesh. Well, we did a few webinars here, Ganesh, in this as a tutorial. So if you came in late, just watch the tutorial, the recording. We covered how to set up the triple moving averages, the MACD, the RSI, the stochastic, and the RSI. Did I mention it already? Yeah, I think I did. But anyway, there. So those I covered, and I did Bollinger Bands in the Q&A. I don't have a Telegram channel. No, sorry. No, 95, Isaac, not 85, 95. Add 10 more to that. Because that's where the previous high level is, or the median price roughly. What's your view on GBP USD? All right, well, that's the last one we'll do. What is my view on GBP USD? That it's moving. No, I'm just kidding. That's me. Let's take a look. Down, back up, flatlined. Why is it flatlining? So that's a low. What's the other one? What's more relevant? What's this, 4 hours? Let's take a look at a day. Oh, there you go. It's not flatlining. See? Relevance of top-down analysis. I'm skipping corners myself. Shh. Nobody say anything. Nobody saw that. Well, that's pretty obvious. Even if it's in a downtrend, it can jump out. It's looking pretty consistent on this part. So it looks like if you take this is a pretty good outset because you'll be trading with the trend. So it looks, also based on our indicators, that did want to go back up. That will probably then wick and hit this resistance right here. Come here. Okay, let's clean it up a little bit. So it's, oh, that's why it's struggling. So it's stuck on this one. That's a daily. Then you have the previous low, and then you get the high after that, which is roughly over here. Yeah, so it's not going to reach that, but it needs to break through this. Let's take a look at a 1 hour. What do we got? Yeah, the 1 hour it broke. See, it broke the 1 hour, so it didn't make, whoops. Oh crap, what did I do? Bugger. All right, well. So it's stuck on this line, that's why. So it's probably going to pull back a little bit, then go back up, hit this line somewhere around here, and then go for the sell. Now the question is, where is it really going to go? Yeah, probably. Yeah, it just came from the previous high, huh? Yeah, okay. So if I would be a betting man, you can safely say it's going to go back here to 128. But again, that's not trading advice. Please don't copy that and legally applied and blah, 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 blah. I hate that legal stuff, but I have to say, it's not trading advice. You asked my question, that's what I would think and do. I hope that answers your question, Yolita. Oh yeah, so 95, yeah. Okay, thank you. No Telegram. I need an ebook on indicators PDF. How to draw lines in a chart. Ganesh, go to YouTube, type in Legacy Effects. There's other webinars that I did for them, including how to draw lines in a chart, like I just did, but a little bit more, not as sloppy, more actually correctly. And an ebook on indicators, I don't have, but I'm sure you can find one. I just say everything that's in the top of my head. So. Oh, holy crap. Wow, you made it to the bottom of the Q&A. Look at that. Today was a good one. Lost a few people along the way, but yeah, we are getting like 2 hours and 10 minutes into the webinar. That should be an hour. Okay. Well, ladies and gentlemen, everybody. Wait, that's the right one. Here we go. So what we're going to do, we'll call it a night. I'd like to thank everybody again for coming today. I hope you guys learned something. I hope you enjoyed the information provided. Now, before you all leave, just a reminder, Legacy FX is an official partner of Real Betis, which is playing on the 18th of October if you're a football fan. And on my note, at the end of the webinar, usually it sends out a survey kind of thing that's purely anonymous, but it allows you guys to give me some feedback, and it can be critique or praise. Either way is fine with me. Obviously, as any human, praise is better than critique, but critique helps me grow. And it also gives you an option to give some suggestions, right, on other topics you would like to see. And that's very important because that helps me push content towards you to see where the majority of people want to hear certain things. Now, if you're a client with Legacy FX, you can actually request through their loyalty program private webinars with me. So literally just a one-on-one session. And then it can be any topic you want because I'll just literally prepare that for you. And you get me for an whole hour. So there's that. And they have other funny things like USB sticks and pens and stuff like that. But hey. Anything else? No, that's it. I think we can call it a night or morning here if you're in Canada. Or midday. What is it now? Yeah, midday-ish. I wish you all a pleasant day. I'm gonna say that. Good evening for those that are going to go into the night. Stay safe, with the whole COVID thing, and stay safe with your trading. Good luck, and hope to see you on the next webinar. Cheers.